Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, along with Brianna Valesky, and we have Mark Martiak on the line. He's a senior wealth strategist at Premier Wealth, First Allied Securities in New York City. Mark, how is the new year treating you?
So far, so good, Joel, and good morning to you and the team, and also to all of your listeners. It's nice to be your guest this morning. Happy New Year to all of you.
All right, we're glad to have you back. Well, first, let's just take a little look back at 2014. Well, even if you hung on until the final end, you did have a little bit of sell-off, in the last couple days of the year. Did the market meet your expectations, exceed your expectations, or fall below?
The market met my expectations and the expectations of my clients and our firm's clients. I think we did very well in most sectors. The energy sector was quite a surprise in equities, of course, and then on the fixed income side, we were also surprised, particularly with municipal bonds for investors that had municipal bonds in their portfolios.
And in the fact that they held up pretty well then, correct?
They held out. They held up very well. In fact, munis returned approximately 8.5% in 2014, and unlike most other fixed income categories, where you didn't see a lot of upward movement in the prices, and clearly investors were tethered to the prospect of the Fed, obviously increasing the short-term rate at some point, or alert to the fact that the Fed's language in their FOMC meeting minutes would signal something that could suggest an upward movement in rates, which obviously never occurred.
And, take into account Detroit had the bankruptcy. You had some problems in Argentina and Puerto Rico. For the muni bond market to hold up like that, certainly a surprise. That return that you talked about, is that, obviously you're not paying taxes on your earnings from muni bonds. Do you lop that in on top of the 8%, or is that included?
That would be included, yeah.
Okay.
That would be included. And as we look forward to other fixed income opportunities, I think a lot of investors and your listeners, Benzinga's listeners, audience, will appreciate the fact that they are going to start to search for more higher yielding income opportunities. And obviously record low yields have made it really challenging to find these higher yielding income opportunities with attractive valuations. So the impact of that is that investors are going to stretch for yield, and especially income-oriented investors. They may be tempted to take on a little more risk in pursuit of yield, and that's the impact. The result of it could be compromising capital. So overreaching for yield can put an investor's hard-earned income, or hard-earned capital, rather, in jeopardy.
And so let's look forward to 2015. I guess my first question, were you able to stay out of the oil patch? Did you have exposure there? Because like a stock like ExxonMobil, did hit an all-time high, has pulled back on that. Was it just something that, you were in, you got stopped out of, you reevaluated, or is it something you're still stuck in? How did you play the oil sector?
I was I had clients in the oil and energy sector through either mutual fund exposure or ETF exposure, and in many cases individual equity exposure to that sector. However, at some point we started to really, as we do often with our clients, really look carefully at the allocation and understand where we were seeing returns. And probably about 6 months prior, let's look like sometime midsummer, we started to realize that energy wasn't yielding us a lot. And if you look back 6 months ago now, energy is down as of yesterday 22% as a sector performer. uh, versus the top performer in the in the sector's equity sector space, which was essentially ended up being healthcare, which was up almost 14%. So, to the long answer to your question is, we rotated out of energy, and we took some losses, but the rest of the portfolio made up for it. We see, one surprise in speaking of sectors, Joel. Well, we didn't expect utility sectors to benefit from the unexpected uh, drop in interest rate. So, the utilities, you can look at the utility sector, and over the past 6 months, we were up as of last week, like about 20% over the last 52 weeks. As of it's up 14%. So, we see that sector benefited. It wasn't included in the client portfolios because most clients didn't want to be as defensive. But when we spotted the trend and looked at what was going on with the energy sector about midsummer, we realized we had to slowly reduce our exposure there. But overall, we did have exposure. Utility wasn't a sector we put on, and I think utilities could be problematic because it's been trading now at a premium in the market. Historically, utilities have traded at a steep discount. So that's in a rising interest environment. Like again, we in fact are anticipating this year, probably near on through the end of the utilities could be like you may not want to have that exposure to because they could get hit. It's just like most fixed income. Utilities tends to be a proxy for fixed income class.
Okay, so you're gonna look to re-enter the oil sector here, or it's just, you're just gonna let it do its thing and wait for crude to try and find a bottom here before you. I mean, you just like your hands off. I'm done with it. I'm moving on. There's better places to put your money, or are you still keeping an eye on it for a potential entry?
Keeping an eye on for potential entry and having discussions daily, if not certainly, weekly, if not certainly daily, with clients that want to see where it settles at a bottom and then get in. So we're looking carefully at, we're watching it because we don't want to miss opportunity. The last piece of news or information I want to share with any of my clients during a review, which I just on a quarterly basis, tell them we missed this opportunity when we could have benefited from it. So I'm looking at it carefully. I think we're going to look for markets, with tailwinds. So I know we're going to look for markets with tailwinds, rather, either in the form of monetary stimulus or the structural reforms. And that includes developed Asia, for example, Japan, as well as emerging markets within Asia. So outside of the energy sector and oil in particular, we're gonna keep an eye on developed markets, Europe, and emerging markets. And in Europe, the situation is very different. Markets are caught between the counters of growing geopolitical risk, right,
Yep.
and headline risk, like what happened today in Paris, for example, and the upside potential from further easing by the ECB. So we want to see what the tailwinds are as well as the headwinds in terms of those risks that I just mentioned. And
Uh,
as you know, too, this month there's going to be some geopolitical risk once again focused on Greece. We're revisiting a theme that was on our radar screen like 3 years ago, approximately, right? And because the parliament failed to secure the necessary majority to elect a new president, so another election scheduled for the 25th of this month. And so we're going to look at that and see how that influences the market, and in fact, whether Greece does belong in the Eurozone.
Mark, I don't know if you had a chance to join us on Friday, but we had a great show on Fed Forecast 2015, and we had a couple characters on, Peter Schiff and Ron Ansana, and they were really going at each other as far as their outlooks for the market. Peter kind of with his gloom and doom scenario, and Ron looking for the Fed to stay the course. I think that a lot of the bull market, a lot of the gains have been predicated on the fact of the easy money from the Fed. What's your outlook for interest rates in 2015? I mean, I think the consensus is, yeah, they're going to go up, but how much are they going to go up? And then if you go to Peter Schiff's scenario, there's no recovery out there. This economy's in terrible shape. There are companies that we got to rid of, and he's looking for QE4 before he sees a rise in interest rates. Well, who are you teaming up with on that?
I like both of their perspectives, and I respect both of their ideas. I would probably tend to sway with Ron Sana. I really think that the Fed will end monetary easing by mid-year, and again, I can't predict with any certainty. I think we do have an economic expansion underway, obviously, based on reduced jobless claims, including, if you saw this morning, the AE report. We're growing payrolls. We're not reducing them. I think the Fed actually look at they look at the indicators. They look at the producer price index reading. They look at the CPI, core CPI reading, and they look at jobless claims and that growth. So as long as we don't have a surprise, and I don't see a reason why we would have a surprise. I mean, Q3 growth was coming in. If you extrapolate at a 5% GDP growth rate, that's the best out of 11 years. So even before we went into this, even before the last recession that we just came out of, we were, this reading was a really odd number. So it's hard to argue against the fact that we're having an economic expansion and it's an industrial-led expansion. I see the Fed ending monetary easing in the middle of this year. See the ECB and the Bank of Japan moving toward more easing, which is literally taking a page from the Fed's script, if you will, and they've been on that track. I feel that short-term bonds feel the impact of those interest rate increases more than long-term bonds, because lower rates in Europe and Japan will increase the demand for long-term U.S. with relatively more attractive yields. So that, as well as several static trends that will keep long-term U.S. bond yields low relative to interest rates. So I don't think we will have any issues. And in fact, I think that quarter earnings have been good. They haven't been great. They're not lackluster either. So earnings drive the stock prices in the long run, and emotions drive them in the short run. So in between there, the market speculation is a sport that's engaged, by many and kind of mastered by few. So I think PE ratios, whether they're selling, have been poor predictors of future performance. So for our audience, for your audience and my clients, better approach for is to assume an average earning rate of, let's say, somewhere between 6 and 7%, and consider a range of PE, price per earnings ratios, scenarios. So consider scenarios, and then that approach would suggest market may produce a total return of about 8.5% over the 12 months, which end August 31st in 2015. So there, but I'm suggesting that not to look so closely at PE ratios when you're looking to see what you want to add or play out.
Okay, we've been on the line with Mark Martiak, Senior Wealth Strategist at Premier Wealth, First Allied Securities, joining us here on Benzinga's Pre-Market Prep, brought to you by MarketFi. Mark, thanks for your look back at 2014 and what you're looking for in 2015. We appreciate your input, and we hope to have you on again soon.
I look forward to always being a guest on your show. I really appreciate that. Again, Happy New Year.
Okay, Happy New Year to you.